back to Fast Market here on the TD Ameritrade Network. Let's bring in our next guest for our cash tag segment. That's going to be Andy Swan, co-founder at LikeFolio. Welcome back to the show, Andy.
Yeah, thank you for having me.
All right, so we're talking Starbucks. The stock seems like it needs some caffeine at this point in 2023. It's barely up 1%. And it seems like, Andy, I know that your data out of LikeFolio focuses on the U.S., right? What you guys have here as far as mentions and data goes. But at the same time, this seems like it's a story about China not performing as well as they could. Are you still seeing robust U.S. data? Because it seemed like last quarter, the last couple of quarters, it's growing at double digits. People are spending more money. It's become a staple instead of a discretionary item. What kind of data you guys have?
Yeah, I think you've nailed it there. It's kind of a staple instead of just discretionary item. And, just to be clear, LikeFolio data covers pretty much all of the English-speaking world. So that can actually penetrate a lot of markets worldwide, but really not China. So we don't have much information on what's going on inside of China. But when we look at Starbucks kind of versus, I would call it fast food competitors, are really not sure what category to put Starbucks in other than, kind of an addictive product, an addictive company. But, this chart really shows all of these competitors, everyone from Shake Shack to Starbucks and McDonald's, all plotted out. And you want to be further to the right and further up, because further to the right means more and more people are talking about your brand and products. Further up means that your customers are expressing higher levels of happiness. And you can see at the top, Chick-fil-A really sets the standard for the fast food industry in terms of customer satisfaction. And what we're seeing is kind of a little bit of a breakaway or a shift in the old guard to the new guard. You've got Shake Shack and Chipotle over on the right, pretty good happiness levels. These kind of seem like the future of the fast food industry, where you've got kind of the old guard all together with slow or declining growth in consumer enthusiasm and a kind of lackluster level of consumer happiness. And Starbucks is just kind of right in the middle of that. So I think the Starbucks play here is really just one of how much are they able to squeeze out of the wallet of each customer that comes into the store or through the drive-thru. We don't see any indication that, at least in the English-speaking world, they're really exciting the customer base or new prospects. I think it's more about how much are they getting out of each customer coming through the drive-thru or online and through their digital initiatives. And so overall, we kind of think Starbucks is doing what it should be doing right now, and that is relatively flat stock performance, because we don't see anything exciting on the horizon. In fact, we think it's going to be difficult for Starbucks to have a really positive message going into this earnings call.
Yeah, I'm seeing North America accounts for about 3/4 of the revenue for Starbucks. So no China data, no problem. Andy, we get a pretty good look just looking at the U.S. But what I was going to ask you, and I think you both allude to a point that I've been making for a while, at least amongst my kind of generation, it truly does seem like, regardless of what these coffees cost and the fancier they are, the more expensive they are, that this is truly one of those things that the millennial generation is willing to shell out cash for and will give up last. They would forego, maybe a vacation if they could have their Starbucks on a daily basis, it seems. But with that in mind, I look at this data that you provide, Starbucks on the lower in terms of percent positive now, and total mentions is fallen almost 20%, it looks like. This approach of trying to squeeze out every penny, this approach of constantly adjusting the rewards program to make it a little bit less positive experience for the user, are they losing loyal customers who are finally just like, how much more are you trying to take from me? Or is it just such a loyal consumer base that even though they're kind of being abused at this point, they're just still coming back?
Well, I hate to be this guy, but I think it's really a mix of both. I think that we're kind of getting to the point where they're really pushing their customer base to that edge. So as a potential investor, or if I were a shareholder in Starbucks, my question for management would be, it seems like we may have squeezed everything we can out of our most loyal customers. What are we doing to draw new people in the door? Because this brand is not generating excitement. It may be delivering fairly well for those who are already kind of addicted, already have it as part of their normal day-to-day routine. But what are we doing to attract the new customer, to make people excited about our menu, about our offerings, about our brand? And right now, I don't see very much on the horizon for Starbucks. And I'm concerned that management might not either. And it may be more about managing some store closings, managing the store openings that they have, too much focus on international expansion, especially China. And it feels like that big 3/4 of the revenue chunk of North America is kind of gotten stale. And I feel like that goes for a lot of fast food restaurants in that quadrant. Just feels stale. What is next? What's the next big thing? I don't think anybody has a great answer for that.
Well, they're trying that, what is it, olive oil infused stuff, and I think that's already fallen off the cliff at this point, Andy, as far as popularity. But if you look at this from a happiness level, it still seems like maybe it's a staple. People still go back there and they'll spend more per average ticket price, which is helping their margins at this point. But have their happiness levels come down? And what kind of earnings score do you guys have on this one?
Yeah, happiness levels down a little bit. And look, this is one of the best run companies in the world. So I don't think that this is, any huge red flag. I just think it's one of those stories where you kind of wonder what's next, wonder how they're going to generate excitement around shareholders. So we have a slightly bearish outlook for the company going into earnings. Just doesn't seem to be any impetus to get excited to buy the stock. And I'm not sure what management's going to come up with. It doesn't seem like there's a rabbit to pull out of the hat for this quarter.
Yeah, and stock is reflective of that so far in 2023. All right, great stuff and great data as always, Andy. Have a great day.
Thank you. You too.
That's Andy Swan, co-founder at LikeFolio, breaking down the data. You know what? Their commentary and their data kind of matches up with what's going on in the stock this year, up 1% so far, Alex. But if you look at their profit margins, were up to 14.1% of sales last quarter. That was 12.4% 2 years ago. So they have, helped themselves as far as profit margins go because of that higher average ticket price. But, with their data and China still not in full recovery mode, is this one of those quarters where the stock's setting up for that, or how do you want to look at this from an example trade?